Okay, good, welcome. Today we're going to talking about PD arrays. So what is PD array actually? Well, PD array matrix is formed by two things. First is the PD array. And what is PD array? PD array is premium and discount array. Okay? So, what we can see in those areas? Well, if we are in discount area, we want to see the market retracement to this area and then give us some opportunity to buy. And if we are in discount area, for sure, we're expecting that the market retrace back to the discount area and have the best opportunity to sell. So, how do we use this premium and discount? Okay, we are in our last leg. So let's say example this one, and we're gonna mark from bottom from the top, and this is our PD array matrix area. So we go bullish, and as you can see, we expecting the market make the retracement into what? Into discount area to find a better ways or a better moment to buy. So if we use opposite side, we are here. We come from the top to the bottom. Let's say again, this is our lats, our recently legs, and then we mark from the top to the bottom, and then we expecting the market make some retracement to the area inside of, in this case, premium area. To what? To give us the opportunity to get the sell and catch the movement. Okay, so that it will be how we can use that premium and discount area. But okay, what's happened? How we know where in this discount area the market could make some reaction? Well, that is when we start to use the PD array matrix. Okay, what is PD array matrix we're talking about? This is PD array, and those areas in here in discount and premium, when we go to find that reaction, how we know there are the places? Okay, what do we see inside there? First, we want to see is a mitigation block. Second, we want to see a order block. Sorry, a breaker block. After that, we will see a swing high or a swing low. Later of that, we want to see a fair value gap. Then we want to see another block. And the last but not the least, swing high or swing low, previous swing high or previous swing low, or also known as all swing high, all swing low. So let's mark as previous X. It could be daily, yearly, monthly, previous swing high, previous swing low. So that's why I'm gonna put the X. So that's what we want to see. And what is the order we want to see first? If we go in the discount, we want to see like that. So if we are in premium, we want to see the same but opposite direction. I mean opposite side, upside down. First mitigation block, breaker block, swing high, swing low, fair value gap, order block, and previous highs and lows. So let's mark this in here to don't miss. Sorry. Okay. Well, first let's go over the basic things, okay? Let's go over order blocks. What is an order block? Everybody knows an order block is the last change of delivery in the state in a swing high or a swing low. Okay, let's mark like that. We're going like that. And we have this movement here. Okay, the last, in this case, the last change in the state of delivery, it will be this one, right? So if we have some sort of continuous candle here, then that will be our order block. Okay, this will be our order block. Usually the people think that is the last candle, but that's not true. It's just the last change in the state of delivery. And what important things to all of this is we need to have three important things. The first, it need to sweep of liquidity. You need to have some sort of sweep of liquidity. Then it need to create expansion. You need to create an expansion movement. You need to create fair value gap. And the third, you need to break a structure. You need to make some sort of break of a structure. Okay, let's see some example here. Okay, here we have. What do we have here? In this case, we have this order block, right? So we have a sweep of liquidity. We have a fair value gap is created. Not in this case. So we don't have the second movement, but we have some sort of break of a structure here. So we have two of them. Is that powerful? Well, not for me, but also it's working. Also, we have this expansion movement. Is, as you can see, is all like white candle. It's bullish candle. So you could use this as idea that the market or that order block is valid. Okay, let's go over this one. What do we have? We have sweep of liquidity, right? This one from here. Then we have a break of a structure. And then inside of that, you have some sort of creative fair value gap. So that is valid. Again, let's go over more simple example about this one. Okay, we could use this one again. Sweep of liquidity, break of structure, fair value gap. That is very, very clear order block. Okay, now we go over some sort of bearish order blocks. Okay, what do we have here? We have sweep of liquidity here. We have break of structure, and then we have what? Fair value gaps, right? Let's find over. Okay, again, we have that sweep, break, and fair value gap. So that is how we know that the order block itself is powerful. What do we need? What thing we need for every order flow is the fair value. For every order block, sorry, is the fair value gap. If we don't find or we don't have that expansion movement or we don't find that fair value gap, probably that order block will not hold or will not be powerful to give some reaction there. So that's the first order block. And then when we go over that PD array, the first, as we said, is a mitigation block. Now we know what an order block is, so we can see the other one. So let's see mitigation block. Okay, mitigation block happen when we have some sort of movement and if in continuation. Okay, so for example, here in this example, this is our mitigation block. Then we break below this high and we have again a mitigation block. Okay, so this kind of order block we will see like the last candle before to make the retracement. Okay, in this case this is our mitigation block. Is it that mitigation block mitigated already? It didn't. So okay, we expecting or we could expecting some sort of reaction below. I mean some sort of reaction back to this mitigation block. In this case, our mitigation block is this one from here. And then here we have this one. So in a bullish movement or in a bullish trend, let me find some good example to explain to that could be good. Okay, so we have what? We have that movement up, that's bullish trend. And where do we find our mitigation block? Well, first we have this one from here. We will use this swing high or the last candle, in this case is this one, for our mitigation block. Okay, so here we have this candle again, or this week, or this candle as our mitigation block. Okay, so this one is not tucked in yet, so that it will create some sort of liquidity, but that's not what we're talking about today. And then, as you can see inside of them, inside of the movement, you also have what? Mitigation blocks. You have this one, you have this one, and you create that new one. So when we have a trend, usually we want to see how the market react inside of that mitigation block or that mitigation area. So that's the first. Second, breaker block. Okay, what is a breaker block? A breaker block is another block who don't be respected. Okay, so let's see. 1, 2, we have that movement, and then the market broke. It didn't respect this order block, this mitigation block, and break below, in this case, in this example, below this order block. So didn't respect them, and then it must to reach back to take this area and then continue slower. Okay, in this case we will use the last swing low, or the candle that we have, but it create that swing low. So let's see some example. So okay, this case, this is not the best, but let's use it. What do we have? We have this swing high, swing low, swing high, swing low, swing high, and then we have this break from here. Okay, in this case, this will be our breaker block. This is our breaker block area. Or also you can use this one, this candle. This is actually is our breaker block. All this area. And then what we expect the market reacting back and then continues lower. Okay, let's find another example here. Okay, nice. Let's use this one. We have the same. We have swing high, swing low, swing high, break. So this, it must be respected, but didn't do. As you can see, even you have some fair value gaps here. So sweep of liquidity, break below the order block and create some fair value gap. So this area is your fair value gap area, or if you want to use the order block itself, you could take this order block for your reaction after the break below. So let's go in over some bullish order block, bullish breaker block. Okay, we can use this one, a smaller one here. What do we have? We have swing high. Let's mark from here: swing high, swing low, swing low, swing high, swing low. We want to see that order block itself here. It must to be respected, but as you can see, it's break and gone. So here, what is our break block? You could mark this one, right? But in itself is this one below, because this is the last swing, the last movement to the opposite direction. So this is our swing. This is our last change in the state of delivery in this movement back. So this is our retracement. Then we have this change. Now, what is our breaker block? Our breaker block, it will be this one from here. And then it break above it, come back inside, and then go. So now you can see, or I can hear as you thinking, okay, how can I see the difference between a breaker block or a mitigation? Okay, I'm gonna use the line. If we have this kind of movement here, and we have just one or some consecutive candle here, that just will be a what? A mitigation block, okay? Because it's just one, right? But if we have some sort of movement like this one, then what we have here? We have first our mitigation block, and then we have another block, a breaker block, sorry. Will be this breaker block here and this mitigation block here. Okay, and then another block. As we say, it must to be here. That's the first we're talking about. Then we have three, in this case, three what? Three premium PD array. So we want, or we will like to see the market comes some of them and then give us a retracement, right? So let's see, let's find some good example of here. Let's use this one. Okay, Okay, let's use this. What do we have? We have premium area and discount area. But in this case, as you can see, the market didn't retracement until the 50%. But we can see what? We already below or in the medium. What do we have? We have this one. This is our what? Mitigation block. And then why didn't come here? Okay, didn't come because I say we use the recently legs. So if we start here, how we mark our legs? Well, we're gonna mark our recently legs with a swing high and a swing low. So this is how we're going to mark our recently legs. So if we have this one, which one is our recently legs? Which one is our recently swing low? This one from here, right? So after we have that break, we have a new PD array. Yep. So we have a new one. So we start here and come to here. So now we can see we have what? A new PD array. So this PD array, we will have what? This is what? Mitigation block. Yes, it's just one movement below. Also, we have another things that we're going to talking about in a minute, but we are just watching this right now. Let's find some good example of them. Okay, let's use this one from here. We have a what? Swing low and swing high. Okay, so what do we have here? From this swing low, we have what? We have first here, this is our break block, and then we have what? We have a mitigation block. And below this, as you can see, this is the last change, change in the state of delivery. So this is our order block. You have three kind of block of orders. Let's find another one. Okay, again here. Let's find a new. Okay, this one. Okay, this one from here is very good. For example, we have this one. This one is very good. So we have this one from here. And then here, what you can see, we have a mitigation block, who is already mitigated. And we have what? We have break block. So in those areas, we will find some kind of reaction. Why? Because those areas are also liquidity. Okay, let's go over more things inside of the PD array matrix. So, swing highs or swing lows. And this is a very good example here. When we are in this PD array, we expect to have the first reaction here, right? It must be here. Right? So what do we have? This swing low, it didn't tap our mitigation block in this case. And what's happened? It creates a swing low. And then we could also say, okay, why I hear you already to say why do you put here or here? Well, that have an explanation, but today we don't going to talking about that. Okay, so here, this is your mitigation block, and then we have what? Expansion and fair value gap here. So what do we expecting? We expecting some sort of reaction in that fair value gap as we have here, right? But what happened? We have a swing high. It didn't create a swing low. below this swing point of here. So what we can see how the market make a retracement, and then when we see this, and then you could see some sort of fair value gap here, you could say, okay, probably this from here, it will not respect it. So what is this? We are creating a what? A swing high. And we want to sweep this swing high as liquidity to continue our movement below those, in this case, equal lows right now, or relative equal lows right now. And as you can see that the market just go below, like just with a faster movement there. Okay, so let's go over another swing. Okay, here we have a pretty similar movement. It's not the same, but we could say pretty similar movement. Okay, what do we have here? Swing high, go below, even get into the discount array, and then it create what? That movement is supposed to be create just expansion, but it didn't do it. So you could see how the movement it's go below, and then you say, okay, what it could happen here. Then I would like to see how this swing low it will take it, because now that become a what? A liquidity. So now we have what? We have here our mitigation block. We have here a fair value gap. And then you could see how in this case, this is a kind of order block, right? He's reacting one, then go inside, below, create more swing lows as liquidity, and then finally go to sweep those liquidity. Didn't tap in any kind of place I can see. I mean, you could say, okay, we have this order block here, and we could use as rejection. Yeah, we could use, but for me that it's already mitigated by this wick from here. So as you can see, sweep this. Many people get entry here using the same idea you get in those area from here, and then the market what's do? Sweep all those people who enter here, sweeping into the low, because many people put here the stop loss, and then they sweep that low, and boom, going up with a powerful movement. So once you tapped in here, it have that kind of movement many times, probably means that order block itself, it wants to be respected. So what do we expect? It sweep this low, and then it could going up again. But in this case, it's sweeping these swing lows and those swing lows from there. Okay, let's find another good example to see this one more. Okay, nice one. We have this one and this one from here. Okay, what do we have here? First, we have a what? We have a breaker block. Then we have a mitigation block here. And we have what? We have a order block. We have a fair value gap. Okay. So as we can see here, the market wants to going up, going down, going up again. And why I don't use this swing low as a new swing low? Okay, first of all, for me, and in the market, when have expansion movement, you will see some sort of powerful movement, like this one, for example, or this one. When the market wants to take like real a swing low or a swing high, it will create some sort of powerful movement or expansion. And that expansion need, for me at least, to have one or two imbalance. If you have two or more imbalance, is better. So as you can see here, you 1 and 2. That means it will really take this low, but in this case it's just like a week, and then you can see how immediately it's going down, creating what? Creating a new fair value gap. Okay, so in this case I say, okay, this is just sweep of liquidity, and then I will go now inside of that. And what I have here, I have what? I have mitigation block, I have here break block, and I have my order block here, those candle and roll. And that's how I mark it. And now I know after that swing high, in this case, I will sweep that liquidity. And now we go over the last point, no, not the last, but previous to the last, and for me the most important one, the fair value gap. Okay, what is a fair value gap? Well, you need to know the market works in two ways. If the market, you need to know the market works in two ways. It offering fair value or sweeping liquidity. And in the part of offering fair value is when everything is okay. Then when we have a fair value gap, what means? We have an unfair price. Also, you could know as imbalance in the price action. Okay, we come here, we go in fair value area, and we have this one. So this area from here, that is unfair area. That is the imbalance in the price action. That is a fair value gap. So that means the market create some sort of gap, and it will return to tapped inside of them. So as you can see here, what do we have? A fair value gap, a fair value gap, and a gap. So what the markets do? So the market comes to react in where? It comes to react in our fair value gap. Okay, let's see some more example about that. Okay, let's use this example from here. So my recently legs, in this case, it will be this one, but also you can use this one because, as I say, when you have a one expansion movement, that is the swing low that you want to be holding. But let's use as traditional way this one and this one. Okay, what we can see here, we have expansion. Okay, you could say, okay, it will sweep with this one. Yes, but you have a huge expansion above it. So let's mark all what we find right now. What do we have first? This is our first line of defense. Is the mitigation block, is already mitigated. Then what do we have? We have this here is our break block. Those from here. And then we have here our order block. This down candle. Okay, and now what do we have? We have our fair value gap. And then as you can see, it comes to tap inside and then going to give us some expansion. Let's go in over another example. Okay, let's use this one from here. We have those. We have this area from here. And then what we can find here, find our mitigation block. Yep. And we can find what? Fair value gap. And then we also create what? Swing points. Now you can see how is everything combining. When we tap into the fair value gap, we're expecting some expansion movement below this swing, this fair value gap. and it didn't make it. So as you can see, it's just reacting here, so it didn't tap. And what's happened then? Going below again, below to this swing high, and then this fair value gap is already mitigated. Now it mitigate below, above this swing high, and then give us the reaction back. So here again, we mark here, and what do we have? For me, always first fair value gap is the easiest way, but we also have what? A mitigation block is this one. I marked it already, and we could say we have this order block here, because that's the last movement up before to change. And then, as you can see, the market comes to mitigate in the fair value gap. And then we have that change, that here the market changed the structure, then we go up, let's mark this swing, and what do we have? Mitigation block, and break a block, and of course the other block here below. And as you can see, the market didn't come inside of none of them. And now we're going to over previous swing low or previous swing high. So what is previous swing low or previous swing high? Well, the previous swing low, as the name says, is the previous swing low you have. So as I said before, when we have a swing low or and swing high, we create our what? Our PD array. And then that must hold, right? But as you can see here, it didn't. So it didn't tap, so that create a new PD array, right? So as I say before, it must to hold, but here didn't do it. Why? Okay, because this, as I mark here, this is also the last line of defense. So this is the last point you could have a reaction. This is the last point you will have. You will want to see some sort of reaction in the price action before to continue the previous trend. As in this case, you could see you have a retraction below. I mean, you have a swing low and you have a swing high. So what we could find here, do we see some sort of break a block? No, we don't. Any kind of block you have here, just you say this one here is, it could be your mitigation block. So you have the reaction here, you have a new creation of what? You have a creation of a swing low. Sorry, you have a creation of a swing point. You have a new creation in this swing point, and you have a what? A sweep of liquidity of previous low. And then you see how the market start to create a movement to the top. You see, it's just sweep by wick and going up to sweep the previous high or the external range liquidity in this case. So what I mean by that, not only the market reacting here, that's why many times you put here your order block and then some sort of movement come below, take your sweep, take your order block, also take your stop loss, and then going in the right movement. And that's why many people say, okay, the market play against me because take my stop loss and then it's going. They don't use this as the liquidity. But they need to know, or you need to know, as you know now, this is the last line of defense. This is the last point of liquidity you will need to take care when you are trading in the market. So let's try to find another example about this. Let's say example, this one is not clear enough, but let's use it. We have this one here, right? We see the market come below. We have this swing high, this swing low. It come below this swing high. That swing high was reacting in this mitigation, in this order block. Sorry, here. Yeah, in this mitigation block. This order block is another kind of order block, but we don't go into talking about that in this case. But you could use also this one from here, okay? So we have that mitigation block inside of what? Inside of the fair value gap also. That's how I use actually. And then we expecting what? We expecting the market come to sweep this high. So it sweep this high, it create a new one. And you could say, that's what I want to say, this is the example. It isn't, but let's say it will work like that. Let's say, okay, we have a new swing high and a new swing low. So what I'm expecting is the market don't go over this swing high. We don't expect the market go below, above this swing high. So now we have that expansion and sweep what? Sweep this entry point. And then it will take the liquidity and go below that swing high. I will mark with this. That's not easy example to find here. I just have that one before. Let's see if I can find another one. Good one I want. I can see anything right now. I can see anything right now. But I will make with this example. So we have this going up, swing high, and then we create everything, and the market just take below and go again. How we could call that? We could call it a stopped hunt because it is hunted. That stop you put below. If you have your entry here, like for example, we have a kind of fair value gap or whatever you want to have. If you put your entry here and you put your stop loss just below the last swing low and your TP is in the high, then what the markets do? The market don't respect this or those liquidity area as mitigation block, as fair value gap, as order block, and go below this previous swing low, create a kind of movement below to sweep those liquidity and then start give you a movement to the opposite direction. How do you know you create a new or how do you know the market goes now in your right direction? Because the market, it will create fair value gaps. Okay, so now we have all the picture to how use that PD array matrix, and now you could know how or what is the best area or how to catch the best movement in the market. Also, you need to know it's not just about PD array. Also, you need to know the time frame and the news. There are two important things to know or to give in your mind when you are using the PD array metrics. okay, some kind of movement. For example, when we have that sweep below this previous swing high, swing low, usually it created by some sort of news. Not all the time, but it's created. And also is because we are not in the session, in the kill zone or in the right kill zone to use that movement, and it create some fake move, and then it go to sweep that liquidity. For example, let's see what time is this one. This is daily time frame. Let's go to see some example in 15 minutes if I can find. Okay, this is the case. In this case, as you can see, this is Asia. So in this area, you don't want to catch. I mean, you don't want to catch any trade. Just except if you work with another kind as JPY or Australian dollar, then you could go in Asia and catch good movement. But here, in this case, as you can see, we have this. This is UTC plus 2. So this is Asia for me. I will mark here. This is Asia. I don't want to trade here. What do I want to know about here? Okay, I got that sweep, this swing high, and I create immediately fair value gaps. So now I have a new what? Premium and discount array. And now I have swing low, swing high. I could say, this is the normal people how to see, but I could say I could use just this one from here, right? And then what I have, where is my big reaction? In a fair value gap. And after sweep, this swing high. And now again, I have a new movement. At what time is this one? This is almost open New York. And then we have here the real New York open. Or yeah, for my time is 4 p.m. around 4 p.m. Yeah, it's this one around here. And then we could find again. We have swing high and swing low, right? Why I don't use this one? Because it didn't break anything. Didn't break anything. So that is inside. So what I have created here, I have created this fair value gap. I create that mitigation block here. I create that swing high. It didn't. You can see how it come to sweep after that. And I create what? That is my order block here. So you have liquidity in form of swing high, those here. Then you have fair value gap here is reacting already, and you have order block here. So those are your PD array area, and you have that swing high here, but it's extremely low probability it goes here because you have some sort of liquidity created already. So you don't need to go here to take any liquidity. And then you create again swing high and a new swing low. So that's the way how you could use your PD array metrics, and how you could find the best opportunity for your entry model. So I hope that helped you, and we see you in the next.